Hey option traders, for today's strategy, we're taking a look at a calendar spread in JP Morgan. With JP Morgan trading around 131, setting up a calendar spread at 130 gives the trade a neutral outlook. Calendar spreads are a neutral option trade, which means that we don't want the stock to make a giant move up or down. Ideally, the stock will just stay in the same trading range it's been in. A calendar spread is an income trade that involves selling a short-term option and then buying a longer-term option, both with the same strike price. And the idea with the trade is that if JP Morgan remains around 130 for the next few weeks, the sold option will decay at a faster rate than the bought option. And this will allow the trade to be closed for profit. Usually this is done with monthly options, but it can also be done with weekly options. And traders typically use call options unless the trade has a bearish bias, in which case you would want to use puts. But for today's trade, we're using calls. Investors could look to sell a February 19th 130 call and then buy a March 19th 130 call. So let's take a look at JP Morgan stock and set up this trade together. So now we're on my Thinkorswim trading dashboard. And first thing you're going to want to do is type in JPM in your ticker symbol box for JP Morgan. We're going to take a look at contracts that expire the week of February 19th. And this is preset for February 19th and February 26th, but down here in this area, you can change it. I've changed it to February 19th and March 19th, because those are the dates for this trade. And it sets this up for you if you put in calendar spread right here, select that in this box. And here are the strike prices in the middle panel as usual. We're going to be in the 130 calls, which is on this side of the screen for calls. And I have the trade set up down at the bottom calendar. We're going to be selling February 19th and buying March 19th. And the total cost of the trade will be around $203. And that is also the maximum amount you can lose. The break-even prices for the trade are currently estimated to be around 124 and 136, but these can also change slightly depending on changes in implied volatility. So for this reason, calendar spreads are considered to be a more advanced strategy and they're not recommended for beginners. For a trade like this, I would set a profit target of around 25% and then consider closing the trade if JP Morgan stock breaks either below 124 or above 136. And to recap, this option trade involves selling a February 19th 130 call and buying a March 19th 130 call. The total premium paid on the trade would be roughly $203, and maximum risk would also be that amount as well. And there you have it. I hope this was another helpful trading strategy. And please remember that options are very risky and investors can lose 100% or more of their investments. So make sure you practice with a virtual trading account before risking any real money, especially if this is new to you. And check out investors.com/futures-options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.